Hello, everyone, and welcome to another episode of Idiot Investor. I'm your host, Justin Alexander, and the week is over. I just kind of wanted to go over what happened this week. Yeah, so we gained this week on the S&P about 1.3%, I believe, versus the Nasdaq's 4%. Really outperforming. But today, on Friday, we saw somewhat of a reversal in value doing better than growth, up 1.85 versus zero point 0.4 for growth. And that's some of those unloved sectors coming back, like financials. I've been saying financials and utilities, and they finally did better today, outperformed. So, something to keep on your watch list. The banks are coming into earnings season next week. So they're probably either going to tank or they're going to do pretty good. Who knows? That's pretty much all I got into. I'm watching. Actually, no, I finally bought iClean. I got in at 13.50. I saw the market was up. I saw this was down 0.5, and I thought, it's probably going to catch up. So I got in at 13.50. At a high of 14.30 and a low of $8. So it's risky. But I think the clean energy, and that's going to be a real mover. Let's see. I'm watching those tech stocks to see which are going to be falling. AMD, Intel. Qualcomm's a little too high right now. Those utilities did damn good. Looking to get into SO. Part of that love for utilities and clean energy is the electric vehicles and cars and using more lithium, and these are two stocks that you guys should maybe consider if you want to get into a lithium play or electronic vehicles and batteries and all that. ALB is the largest lithium producer. They have like a mine or whatever, however they make it. I don't know. But it's been a good mover. It's positive. It's up for the year. And let's look at SQM. This is a ADR, I believe, of a Spanish company. And they've been moving too, up 23. Slightly down for the year. A weird ass graph, but people had high hopes for lithium, and I do too. Good dividend, that's why I like them. Decent dividend. Because I found those by looking up the lithium ETF. LIT. Maybe one you want to consider. It's got a high expense ratio though. I don't like that. I'd rather just buy the couple top stocks in there. So yeah, ALB 90%. Looks like SQM has moved off the top 10. So it's worth looking into these companies. I don't think that second one is available on Robinhood. Let's take a look. JNF. Nope. So maybe it's on Schwab or something, but see if BYD is on there. BYD company, what do they do? Chargeable batteries, they make and sell. Wow. have been a good year. Get in on them. So that's kind of how I find some stuff. Find good companies. If you look at Newmont, that's one of the largest holdings in the Ring ETF. That's why I picked that one up. Pays the best dividend. One of the best of those material companies. So Ring is the gold miners ETF. Probably one people should be getting into because gold is moving. Relatively low expense ratio compared to some of the other peers. Yeah, Newmont is by far the largest, followed by Barrick and Wheaton Precious Metals. Those are all three companies that I want. So let's look at Barrick. Okay. Cracking all-time highs. Makes sense. It's part of the miners. They have somewhat of a low yield, 0.8, 1% for Newmont, and Wheaton Precious Metals, 0.8. So that's, you get low div either way, but high growth, beating the market. That's something to keep in mind. Let's take a look. What else do we got? I think energy, still avoid. I don't think now's the time to be buying. I don't know if it'll ever be a good time, but avoid that. I'd go for more renewable resources and all that. REITs and high yield. The banks did really well Friday. Let's hope they can hold that and not absolutely tank. One thing that I heard is TIPS, Treasury, inflation protection. So that means when inflation goes up, these go up equally in I think their yield, or maybe their yield goes down and the price goes up. Either way, that could be something worth looking into. I saw a 3% increase in services, inflation-wise, so that's like restaurants and asking a plumber to fix your stuff. I think that falls under services. Anyway, healthcare is Gilead types. And Cure, I think they might have Cure. Actually not moving that much, surprisingly. Maybe because they still don't make money, probably. They're making money, so I would expect them to be up more. Maybe worth looking into. Already has a pretty big market cap, 95 billion. Adobe, Nvidia, Broadcom. I'd love to get into all those, but too expensive. God damn you, DocuSign. God, I wish I got in on that when I started. I saw it too. I was like, oh, DocuSign, that's cool. It's a public company. Everybody uses that. Everybody knows that. Only $50 or whatever. Now look at them. $38 billion market cap. They're probably going to go to $100 billion. I'm just going to sit on the sideline. That's all right. That's why you buy the growth ETF. Viacom, definitely thought about when the market was falling. I didn't pull the trigger because I thought, nobody likes Viacom. So low quality. It's only going to stay down, but it actually popped big time. Really surprising to me. Only 14 billion market cap, so maybe that's why they're small enough. Pays a good dividend. Wendy's I sold out of. I made a profit still, but I just didn't see it being that successful going forward. I think they should probably be right back down here. Considering they cut their dividend and now their PE is super high. Definitely not worth getting into. Tencent, all these Chinese stocks, they've been going up like crazy recently. The government can just demand that stocks go up and it'll go up. So I don't know what to do about that. Because at the same time, they might get delisted from these American marketplaces if they don't follow those GAAP accounting principles. So I'd stick with Alibaba and Tencent and the biggest, JD Chinese stocks. And let's go over some ETFs I don't usually talk about. Consumer staples and consumer discretionary. Those are pretty much equal. Let's see on a monthly basis. Discretionary is up more, probably because of Amazon is in there. 20% of the holdings or whatever it is. Yeah, man. Consumer discretionary is murdering defensive, even on a long term. Wow, 70. Wow. That's all Amazon pushing that. So, yeah, if you need Amazon exposure, VCR might be a good way to go. Or just buy a bug. Who knows? Marijuana. It's a joke. It's down. Up 15% last 3 months. Not even keeping up with the market. Even though they're all small cap companies that don't make money and are super speculative. Should be up more than that. Financial sector, doing great. Today at least. What other sectors are there? What am I missing? Let's take a look. I'll show you guys one of my favorite places. No, not pre-market. Market sectors from Morningstar. Okay. Basic materials, consumer cyclical, financial, real estate, communication services, energy, industrials, tech, consumer defensive, healthcare, utilities. Let's look at industrials. That's one I got into before the fall, and because I was chasing. And goes to show that you shouldn't chase, because it's up 4% the last 3 months. Down 20% for the year. And only up 48% over the last 5 years. 48% versus the market's 54%. So it can go from suddenly doing great to underperforming the market long term. This is why you can't beat the S&P. Because if you're doing as good as the S&P, you're doing better than 80% of investors. So keep that in mind. Alright, so I think that's another episode. Thanks for tuning in. Have a great weekend, and I'll see you next week for more trading and advice. Alright, bye-bye.